Our guest this week is Jamie Melzer, managing partner at Altra Venture Partners. Altra invests in late-stage and pre-IPO venture-backed startups via secondaries. Jamie took us on a behind-the-scenes tour of the secondary market, how it works, why it's relevant to early-stage investors and founders, where the market's headed. This is the first time we talked about secondaries on the show, but probably not the last because they're getting more and more important as startups stay private for longer. Please enjoy. Jamie, thanks for coming on the show.
Hi, Joe. I'm happy to be here.
Cool. Maybe we can get started talking about secondaries. It's not something we talked about on the show before. We met at Camp Hustle recently, and I love the talk you had on it. And it seemed like a really relevant subject, but maybe just to introduce it to listeners who aren't familiar, you just talk about what are secondaries and how do they actually happen?
Yeah, absolutely. So I guess let's start with what are primaries, because I think that's what people in venture and who listen to your podcast are probably most familiar with. And that's just the kind of traditional VCs coming in and leading a growth round of funding. So series A, B, Z, D. And those, letters keep getting later and later, but those are primary funding rounds where the company is actually issuing new shares. VCs come in and lead a deal, set a valuation, and then capital comes into the company to fund future growth. Secondaries are simply an investor coming in and buying shares that have already been issued by the company. So it's not a new round, it's not dilutive, but someone needs liquidity. So it could be an early executive or employee, it could be an early angel investor or early stage VC fund that's maybe been in these companies for 7, 8, 10, 15 years now and needs some DPI or liquidity. And so the secondary transaction is coming in and buying those shares and transferring them on the company's cap table. So it's really akin to just buying stock like in the public markets where you would go on your Fidelity or Schwab account and buy Apple shares. You're not negotiating with the company. They're not issuing new equity. You're just buying shares that someone else's holds. It's obviously much easier to do that in the public markets than it is in the private markets. And we can go through a lot of those complexities. But it's the same concept. You're just buying equity that's already out there.
Okay, that's great. Thank you. And to get back into the last part there, you maybe walk folks through what a typical secondary transaction looks like, just as an example. I have a feeling you're going to say there's no such thing as typical one, but we can start with that and see where we go.
Yeah. So the interesting part is, as you know, and maybe your listeners don't, there really is no marketplace for private equity or secondary transactions, right? So every transaction, for the most part, is a 1-for-1 transaction, where as a buyer, you are going out and looking for a seller. And that could be an employee that holds common shares. It could be an early investor from a Series C round. But you have to find the seller, come to an agreement on the price, figure out how to diligence the company, whether you have, access to information to actually underwrite what you're investing in. And then generally, you have to go to the company, submit the transaction. It often will go through a ROFR or approval process, and the companies can block all of these transactions. So you have to be able to get them approved. And then if the company approves it and you don't get ROFR'd, the company transfers the shares and you come onto the cap table and replace the previous holder of those shares. So it can be a kind of complex process, and you can get really stuck, I think, in any of those sourcing, diligence, and or closing pieces of it. So I think we focus a lot on actually the closing piece of it, where there's a lot of transactions that we see that are interesting that are just never going to close. So I think having to navigate all of those.
What percentage of the time would you ballpark the company rug pulls a deal going through?
Good question. So I saw a stat the other day. I always forget where these come from. That something like a third of ROFRable transactions have been getting ROFR'd recently. I think for us, it's far less than that, but that's because we try and solve for that before submitting a transaction. Like if it's likely to get ROFR'd, we probably won't submit it, or we'll figure out a different way to structure it. But yeah, something like a third actually getting ROFR'd. And then I think in addition to that, a lot just get flat out blocked. So like the company has the right to block pretty much. Most companies and most bylaws have the right to block pretty much any transaction that comes through. So they will either ROFR it or block it. And then the rest obviously get approved. But I think the ones that get approved are probably the exception.
I get the right of first refusal piece, but on just outright blocking it, is price a variable there where they don't like the price going through or they don't like the people involved, or what are the reasons?
Yeah, it could be either. Could be either or both. So, some companies I think are more sensitive to price than others. And the price and volume of secondary transactions can certainly impact a company's 409A valuation, which is obviously important to them for issuing equity and things like that. And so they are sensitive to that. Um, and I think the price ones are probably those that are most likely to get ROFR'd. Um, and I don't know if everyone knows what a ROFR is, but a right of first refusal is basically like a company or certain investors have a right to um, buy that transaction that gets submitted. So like if I come in as a buyer, we submit it to the company. I've negotiated this great price that's like 30% below the last round. One of the existing investors in the cap table is like, hey, that's a great price. Like, why wouldn't I just buy that? They can scoop in and buy it. And I'm basically out of the picture at that point. So yeah, the companies can be sensitive to price. And I think more and more we're seeing companies are sensitive to the buyers and just like the number of transactions, the number of people on their cap table or investors on their cap table, and really kind of controlling who gets to come on their cap table. I mean, there's a reason that these companies are still private, right? And most of the transaction volume that's getting done is companies that look like public companies. They look like mid and large cap public companies. They have, tens of billions or even hundreds of billions market cap or private valuations. And they don't want every kind of Joe Schmo retail investor coming on and buying 50K, 250K, even 5 million of equity, really. They want to control who is purchasing that equity, who's coming under their cap table longer term. So I think we're seeing companies get more involved. I don't know if involved is the right word, but just like more sensitive to who they're allowing to close those types of transactions.
Formula for success for early stage ventures looks something like sourcing advantage, picking well, winning a high percentage of deals, and then adding value. And we could quibble about those individually, but that's kind of the common formula for success. What does that look like on the secondary side?
I think there's a handful of different strategies to the folks who are kind of approaching secondaries as an asset class. Some are coming in a little bit earlier in like the series kind of B, C, D, actually coming into like primary rounds and starting to build those relationships and then adding to those positions over time in the secondary market. So that's one strategy. I think another is coming in a little bit later and kind of focusing on these like pre-IPO or like very late stage companies. And it's a very relationship driven market. And so actually getting these transactions, sourcing the transactions, getting access to information, like I said, and actually getting these closed, you have to have kind of relationships, across the board and with the companies. And when we look at transactions, there are kind of good sellers and bad sellers, so to speak, depending on our degree of pre-existing relationship with the company. So if we already have a really strong relationship with the company, we're already on the cap table, we're not very sensitive to who the seller is, and we can kind of come in and just kind of roll up smaller transactions. If we're looking to come onto a cap table for the first time and maybe don't have a pre-existing relationship with one of these big companies, we become very sensitive to who the seller is and what their relationship with the company is. So, pretty senior executives can be good sellers to help kind of navigate that process and get these transactions closed. Coming into like a company-led tender round where we get kind of pulled into that process, get data room access, we're kind of pre-vetted, pre-approved to come into those. Obviously, like, funds that are board members or close to management and things like that can kind of help us navigate that and get approved to actually get the transactions closed are helpful. So yeah, that's kind of our formula for success, so to speak. But I think it varies. Like we're seeing a lot of different strategies kind of come into the secondary space as this market evolves and becomes more well known.
It feels like secondaries have had a vibe roller coaster over the past 3-4 years where they were very in vogue for founders doing secondaries when the market was hot. Tide went out. Everyone was kind of critiquing that after the fact. And there was a lot of negativity. But then I think there was such a drought in DPI that eventually LPs and GPs were like, maybe secondaries aren't so bad for founders, but also for us. And it feels to me like there has been a structural vibe shift there rather than cyclical. But I'm curious for your take on that.
Yeah. Good question. I would say for the majority of the volume that we see is not coming from founders, really. Like, I think the problem that's being solved by the secondary market is very much liquidity driven, and I think it's twofold. One is for earlier investors, so early funds that need to generate DPI for their investors. And if you think about the types of names that are trading most frequently on the secondary market, it's the massive companies that have generated the huge multiples and huge returns for those early stage funds, and they need to be able to return some of that to their investors. And so I think we're starting to see earlier funds get more educated and more involved and like more proactively selling, as opposed to waiting another 2, 3, 5 forever years for an IPO. I think some of the best companies in the late stage market might never IPO, but have created a tremendous amount of value for these funds. So seeing them come in and kind of get more involved in generating that DPI. And then the other side of it, I think, is on the employee side. Like if you are a $100 billion plus company that wants to stay private for as long as you choose to, and maybe forever, you're competing with public companies whose employees also get equity, and it's much more liquid and it's real, right? And so I think you have to more proactively enable liquidity for your employees. And so we're seeing these companies do more frequent tenders, maybe every 6 months, 12 months, 18 months, to generate some of that liquidity for employees. It also helps with the companies who've like issued RSUs and have RSU expiration issues, to kind of come in and be able to solve that in the private market. So those are the big things. Occasionally we'll see the founders throw in a little bit of equity in that, but in the scheme of their overall exposure to the companies, I think it's pretty minimal. I think the ones that were scrutinized are where, you got a huge valuation run up, a founder cashed out of like 200 million in equity. And then, 2 years later, the company was like worth a fraction of what it was at the peak. And like, obviously those are going to get scrutinized, but I don't think that those are the norm. Like, I'm not seeing founders come and sell hundreds of millions of equity in the transactions that we're looking at or participating in.
We were talking at Camp Hustle with your colleague Katie, and she said something that I loved, which was that the male version of owning a Birkin bag is being an investor in Anduril. So good.
Not to be sexist, but yeah, I mean, you could throw SpaceX, Anduril. There's a handful of names in there, but yeah, it's basically when you're on the golf course or at dinner, like being an investor in the hottest like late stage private company is the equivalent of getting the Birkin bag approval. I guess I don't own one, so I don't know. But
when you're looking at these deals rounds, how much of what you're seeing competitively is what you'd say is institutional fund driven versus someone's got an SPV of an SPV, and it's more like, call it retail high net worth money flowing into SPVs versus like a traditional fund structure?
Yeah, it's a great question. I think I wish I had the percentages for this. The secondaries market is super opaque, and so like there's not a lot of great data on it. I think from a volume standpoint, there's probably a greater number of transactions that are on the more retail side, and there's definitely a huge amount of demand coming from the retail side. There's a lot of issues with that, and frankly, like just not having access to information and kind of level of transparency on what you're buying is probably the biggest one. But yeah, we certainly see a lot of those, and those structures are getting kind of more prolific and more complex. I think from a dollar standpoint, we're actually seeing a ton of big institutional capital come into the secondary markets. And I think that, I mean, my view at least is we are going to shift this asset class from being more kind of looking like an extension of venture to looking like more an extension of the public markets over time. And so we're seeing these, multi-billion dollar funds come in and buy $100-300 million blocks and tender offers and come in and replace investors on the cap table. And, that's long-term evergreen capital that effectively looks like, a long-term public investor like a Fidelity, Franklin, T. Rowe, Neuberger, Macquarie, like those types of names we're starting to see come into the late stage secondary market.
You've got an interesting career background, including as being a founder, but also working in credit. And I don't know too many people who work in credit and in venture. Can you talk about how that background in credit translates and is useful with doing late stage secondaries?
Yeah, absolutely. So I started my career in 2005, so about 20 years across different kind of research and investing roles, and spent the first decade plus in high yield, primarily high yield, but high yield distressed credit, and basically investing across the cap table. And so started at B of A in 2006 on the credit trading floor, kind of leading up to the global financial crisis, and was in a really interesting position for a number of years to kind of invest through that and see what a true market cycle, and especially a credit market cycle, looks like. And so became obsessed pretty early in my career with risk and pricing risk and valuation and structure and covenants and what those do in a liquidity or liquidation scenario or bankruptcy scenario, things like that. So it's been a long time on the high yield and distress side. And I think one of the biggest like core competencies coming out of that is one, valuation. Because like when you're looking at a distressed assets that's like coming out of bankruptcy, like you're hypersensitive to the valuation that they're going to exit at. And so being able to put a valuation on pretty much like any company or any asset and then run that through a cap table, from, senior secured debt to maybe term loans and unsecured debt and, preferred converts and like all of the things on the cap table, and then being able to price risk across all of those different asset classes, I think is one of like the biggest, like, I don't know, strengths of being a credit investor. That doesn't translate very well to early stage venture, frankly, where like, you can put any number on these financial models, but like, it's pretty hard to price, right? But coming in and looking at these later stage companies where like you actually can underwrite them and like, you get access to financials, you build with the models, you do probability weighted outcomes and sensitivity analysis and, DCFs and all of the fun valuation sets. And then you run those through, it's effectively a waterfall, right? Like it looks just like a distressed debt waterfall, except for the companies are generally good and have a lot of upside. Because when you're buying into secondaries, what's most liquid is usually common shares and early preferred shares. Meanwhile, these companies might be on like a Series J, right? And so you have this huge capital structure above you with all of these liquidation preferences, hopefully clean, but like there could be different terms and different structures and different liquidation preferences in theory, like on all of these. And so being able to kind of come in and recreate that and price risk across those different tranches so that when you're coming in and buying Series C preferred shares or common shares, knowing what the potential outcomes could do to your, recovery or return is really just a credit exercise. And it looks almost exactly the same. And I'm not sure that all investors looking at secondaries really appreciate like the risk that they're taking on, like coming into these different structures. And interestingly, like what we're seeing from most of these companies is like there's not a lot of pricing differentiation. Like a company will come and do, a Series H round, and like 2 weeks later, the common shares are trading at a 15% premium. And like that's kind of nonsensical from a risk standpoint. But that's how that market's trading right now. And so I think just being really aware of those risks and kind of how to think about them and how to price them, and like it can pretty dramatically change your outcome depending on where you're coming in on the cap table and what the ultimate outcome of the company is. Obviously, we're all buying in assuming everything's going to go right, but when it doesn't, and you're sitting at the bottom of the cap stack, like you get wiped out very quickly.
Yeah, I have a hunch that the people out there who invested in Anduril or SpaceX via an SPV to have their male version of a Birkin bag probably couldn't tell you whether they own common or they're in seed. Probably don't even know.
Yeah, no, I agree with you, and hopefully it doesn't matter at the end of the day. But I still think you're supposed to know what you're buying if you're doing it as an actual investment. I guess if it's a Birkin, you probably don't really care, right? You don't care what valuation you're paying, or you just want to talk about it at the dinner table. Um, but no, I don't think that on the retail side, most investors have any idea which share class they are buying into or what's above them or kind of what the risks are, the potential repercussions of that are. Often, I don't even think they know the valuation that they're coming in at. Like I see some of these things trading on like retail platforms, and I don't know if the company would like me to name names, but one of the very topical ones that you've mentioned. Um, Recently closed a late stage round where the shares on these retail platforms were trading at 100% premium to where the round was closing. So basically, retail investors were coming in at 2x the price that institutional investors were coming in at the exact same time. And I don't know if they even knew that. Like they just thought they were getting access to the company, right? And so it's kind of it's one of those situations where like retail investors really want access, but I'm not sure they understand the cost of that access, if that makes sense.
It does. What's something you've changed your mind about in the last couple of years?
So coming into secondaries, I think I first entered it through a venture lens. So like I come from like traditional Wall Street background, investing in public and private credit, public equities, moved into venture and started investing in growth stage companies, and really like learned about secondaries from that perspective, where we saw them starting to take place alongside some primary rounds for these like hot growth stage companies. I immediately like dove into the regulatory side and the structure side and like all of like the complexities of the market, which I thought were really interesting. At the time, I didn't think the actual asset class was that interesting because it was trading at a huge premium to last run valuation. So there wasn't like a tremendous amount of value there. It wasn't until was it 2022 when we saw Silicon Valley Bank blow up, First Republic Bank, interest rates were rising, and all of a sudden, late stage private market got cut in half. Now, it didn't happen like that. It took like 12 months. There was a big lag behind public markets correcting and credit markets correcting. But that's when I think first identified secondaries as like a really interesting asset class where it's super opaque, it's super inefficient. In scenarios like that, where the market kind of drops off and liquidity dries up, there's almost no floor and like very few buyers. But the majority of the companies were really incredibly solid companies. They weren't going to go raise a 50% discount. So like the only way to get access to them in that kind of environment or market cycle was through secondary. So that's actually when we spun out and launched Altra to focus on the secondary markets. But that's a long-winded way of saying, I think I approached secondaries from a venture lens. And so like when we set up our first fund, it was like, okay, 10-year fund, 2 and 20 structure. Like this is just how it's been done. And so like, this is how we're going to do it. Like looking around, this is like kind of how other people are doing it. And what I've found over the last kind of 2.5 years investing is that this is like a one size fits all structure that just doesn't really make any sense for where we're investing in this market, and is pretty limiting, especially if you think about like what you're trying to solve for the companies and the holding periods. Like as secondary investors, like we are the liquidity for the early stage investors, right? And so when I come into these companies, like I don't want to be forced to sell in 5 or 7 or even 10 years. In order to generate returns and liquidity for our investors. Like we actually want to be the evergreen capital that's coming in and buying out early investors, that's like providing liquidity for employees on, ideally like a recurring basis. So every 6 or 12 or whatever months, so that these companies can continue to stay private. On the flip side of that, my LPs don't want a 10-year fund. They don't want to be locked up for 10 years in a late stage company. And so you kind of have this like weird juxtaposition of like, how do you solve for both of these things of like, we want evergreen capital, we want to buy into the best private companies and we'll hold them until the IPO or for eternity and just let them compound, right? Like I want to be like, the forever capital on these cap tables for the best companies that just kind of compound and grow over time. And so how do you solve for like those two dynamics? And so for our first fund, we just really limited the thesis to companies that are likely to IPO in the next 5 years. And so we have this like natural kind of liquidity event that flows through the fund. And so we, start returning capital to our investors in like a pretty short time frame. But for the companies, well, two limiting factors. One, that means like there's a whole list of companies out there that I don't think are ever going to IPO or won't IPO in that 5-year window that I want to own. And like, we can't really buy in fund one. And so like, how do we solve around that? And then two, for the companies that are never going to exit, how do we get liquidity for our investors while not having to exit these cap table positions that are, like I mentioned, really hard to get on the cap table and to build these positions? And so thinking through fund structure for this kind of piece of the market and asset class. And I think what we're going to see, and certainly like what we're thinking through, is moving away from something that looks more like traditional venture into something that kind of solves more of those issues on both sides, where we don't have this like maturing fund life where I have to exit this cap table position in 5 years and return funds to our investors. We can continue holding these positions long term. I think that's much more attractive for companies and what they're solving for. But then also figuring out how to provide liquidity to our underlying LPs. So I think we're going to see things move more in that direction. So anyway, your question is like what's changed in the last 3 or 5 years. I think for us, it's like the appropriate kind of structure around this market and the direction that it's heading has changed pretty dramatically for me as we see it evolving.
What's a conventional view in venture you think is BS?
That's a good question. I don't know. What's one that you think is BS?
I've got a lot of them. You turned it around on me. I'll do one, and then you can do one. I think the argument that you should have a hyper diverse portfolio at early stage is deeply overrated, with the argument of it increases the odds of catching a unicorn. I think the part people miss is that when you hyper diversify, you were required to get unicorns in order to make up for the fact that you're so diluting them. Yeah. So I personally think that's one that's overrated. I think you also need to bend on quality if you're going to do that. Everyone says you don't, but the reality is you can only look at so many deals and spend so much time on diligence. So that's one for me.
Yep. Okay, cool. That makes sense. Yeah, one that I've always struggled with a little bit is ownership targets. This 10% math. And I get the construction behind it when you're like creating an early stage portfolio and just generally like how the math works. I think as you get into later stage, like for what we're doing, when people ask me about ownership targets, like I can't really wrap my head around it because like no one's looking at ownership targets when they're buying like Apple stock, right? Like it just like it stops making sense at some point. So I think that's one that's either outdated or like just doesn't really apply to where we are investing.
No, I agree with that too. And I think, again, this is coming from having I'm reluctant to say Wall Street background because I wouldn't say I have a Wall Street background, but a public market background. You don't think in terms of how much of Apple do I own. You think of terms of how much of my portfolio is invested in Apple. That's the much more relevant question. But
yeah, and like
VCs don't tend to think in that
how
spectrum.
much is it going to make, and like what's the net IRR? Like
like if I own 0.1% of SpaceX, you could say that's tiny. But if it's 10% of my fund, then hooray, right?
Yeah.
Whereas if you invert that and you're like, oh, I own 10% of SpaceX, amazing, and it's 0.1% of my fund, you're like, well, sorry, you didn't make a big bet.
Yeah. Good problems to have.
Well, Jamie, look, this was really fun. I appreciate your coming on, and I learned something, and I'm guessing a lot of the listeners did too. So thank you.
Awesome. Anytime. It was great to see you, Joe. And hopefully you'll get some good tidbits out of it.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.